Welcome everybody to episode 4 of Blueprint for Closers. And in the vein of building a real estate team, the next guest today is Pete Mauro, who's going to talk about mortgages, specifically in the residential side of things. And thanks for being here.
My pleasure. Thank you both.
Welcome, Pete.
Thank you very much. So yeah, I've been in the business for about 23 years doing residential mortgages. Got a 5-year accounting degree from St. John's. Got out, was an accountant for 6 months, figured that wasn't for me.
6 months, huh?
6 months, that was it. Got into trading, so I was equities trader for about 5 years. And I got to a point where I was kind of done by 10:30, 11 a.m. and I kind of felt like I didn't really have a job. So I was trying to venture off into something else that I could make extra money with. And I found the mortgage business through a friend of mine, and I was kind of doing both for a while. And then I had to pick a road, once reality set in, and I figured at least with mortgages I couldn't lose money. So
he didn't take an opportunity to go to Europe for a year and find himself like
No.
like Jimmy
Like
Thompson
the
did.
and find yourself like Sebastian Maniscalco.
Yeah.
No. I knew where I was. My father knew where I was. But yeah, it was rough in the beginning.
You didn't feel motivated.
What's that?
You didn't feel motivated doing the trading.
No, it was kind of like, sitting in an office in front of a computer and, couldn't really build anything. It was like you're just only as good as your last trade.
Right.
I almost went into trading, and
yeah.
same thing. I also saw the floor that I was on. I think
Yeah.
started with like 500 people, and then it was like 300. I was like, how many of you
Yeah.
guys were here last year? And they were like 500. I'm like,
Yeah.
wow.
Yeah.
Like,
It takes
I
a
just
special kind of, clockwork in your mind to do that. And I still have a few friends who do it very, very well. One of my best friends still does it great. But I just felt like, with my personality and my experience and my network of people that I knew, I
Sure.
just felt like it was just better off used somewhere else.
Beautiful.
So went into the mortgage business. It was about 2001-ish, somewhere around that neighborhood. And then it was rough in the beginning, really, really tough to try to start your network, especially when you're not really a salesy type of guy and you're more like an executionist and a honest and, just
Strange.
a genuine kind of guy.
Strange year too with 9/11.
Yep.
Being in New York.
Yeah, absolutely. And then it was going well until 06 and 07. And then obviously we all know what happened. The real estate market crashed like 20 or 30%. Unfortunately, I had my own loan going at the time. I was buying my first house. I had my aunt's loan going at the time. Right. And the banks that we had our loans placed with literally closed up. It was like 20, 30 banks going out of business on a daily basis.
so what'd you do?
Well, I was getting married, buying a house, and losing my job all in the same month. So it was time to, get tough and just
Buckle
fight
down.
through it. So I joined Wachovia at the time. I figured let me just get with a brand name bank, and that's not going out of business, and start from scratch again and grind, and eventually built my way back up. Bought the house in 07 at, unfortunately, the absolute highest market in American history. However, long story short, 7 years later, I sold that house for the same amount of money that I bought it for.
Okay.
And I now regret that greatly because I sold it for 300 and it's worth like 5. So one of my biggest regrets, selling that piece of real estate. I kind of figured I had, a little equity in there I could walk away with and renovate my new house with it. But hindsight 2020, I missed out on probably $2,300 a month in rent and, $200,000 in appreciation. So
You
live and learn.
what would you say is your specialty within here? Obviously, we're talking about residential
Yes.
mortgages today, whether it's for a primary residence or maybe an investment property.
Yep.
Like, so if your phone rings, what's the ideal person on the line that you would want to service?
Best referral.
Sure. So it could be one of a few different kinds, but the best would be someone who knows exactly what they're looking for, geographically and structurally. Unfortunately, most of, especially first-time home buyers, don't. So it's kind of like a slow mold into that. Once I work with their realtor and once I kind of coach them on, prices and payments and how much more could you get if you put another 50,000 down, we eventually get there. But I think the most important thing I would probably say is to get pre-approved long in advance, because a lot of people who come to me, they really have no idea. And it's like they got married, they have their savings, they want to buy a house, and they
Right.
absolutely have no idea what they could afford, what they can be pre-approved for, geographically where they want to live. So I tell my clients, sometimes they're like, well, we're not looking to buy for another year. I said, well, perfect. You are at perfect timing. Right now is the time to get pre-approved. This way, next year, you know exactly what you should be looking for.
It's the couple on Zillow at 2:00 in the morning
Yeah.
that has $30 in their bank account, and they're looking at $7 million house
Yeah.
on the beach.
Yeah, that's exactly
So speaking
it.
of that,
Yeah.
how often should you be picking up the phone and talking to you again? Because I mean, last year I had seen that where somebody's like, "Oh, I had a pre-approval in January." It was like, well, that's irrelevant.
So I would say,
Granted, that was a crazy time.
I would say I don't think that it's a mystery when rates go up and down. I mean, there's enough information through social media. CNBC posts the 30-year fixed on the bottom right-hand corner every day, every second of the day. So I feel like if you're pre-approved at 5%, and you kind of hear and see rates are going through the roof, it's probably time to pick up the phone and give me a call and say, hey, I know we got pre-approved at 5%. What does it do to my payment now that it's 7%?
Right.
So I would say to your question, probably every 3 months, pick up the phone and say hello.
I figured. Yep.
The intention of this podcast that Rob and I are doing is really to educate not only ourselves but our viewers about everything real estate, and how to invest in real estate, how to buy real estate, how to manage real estate. When someone's coming to you, whether they're a weathered investor or if it's a first-time buyer, what would you say are like the top 10, 15, 5 things that they should either be prepared to be asked or they should know when they come to you?
So it's a great question. The number one thing that I would say to know going into that conversation is try to keep your credit and your assets as quiet as possible, meaning try not to let people run it as you're leading into these conversations unnecessarily. There's no reason to be standing at ShopRite or Macy's and just to get 10% off having their credit run leading into this. They could lower their credit score potentially, and movements of money. I would say that is the number one thing that complicates mortgages, is movements of money prior to coming in and applying. And it's not that they're doing anything wrong, but we're going to paper trail every single movement. So if you have your cousin's account that you moved into your money name and it was for whatever, you're just giving you money for a football pool or something like that, we need to paper trail all that. So I would say first and foremost, credit and assets quiet. Consistent job and employment is another one. So when people go from 1099 to self-employed or from W-2 to self-employed, not great. Going from self-employed or 1099 to a W-2 to a salary is
more
okay.
stability.
That's okay, yes. But going the opposite way, like sometimes people go from a regular normal salary job to per diem, and I get it, you make more money per diem, but from a lending point of view,
Doesn't look good on
it's
paper.
a little bit more difficult to figure out what income we're going to be able to use. I would say also be prepared to act quickly. In 2014, when I bought my primary residence, I bought it in 20 minutes without even my wife seeing it. Even then, it was insane.
Wow.
Not as crazy it is now, but it still was insane.
2014 was pretty crazy.
2014 it took me 18 months to find my house. It was a Wednesday afternoon. I was sitting at my office. My wife texted me, hey, did you see this house? I said, no. I texted my realtor. I said, meet me there in an hour. He was sick as a dog. He met me there. We bought it in 20 minutes.
Wow.
And you have to act quickly. During the process, you will figure out with your significant other the things you have to have and the things that you can kind of negotiate and say, you know what, we can either
live without it
or
tell people all the time,
later.
needs, wants list, needs, wants list.
Absolutely. Another thing that I kind of jotted down is have realistic expectations for your house condition. Another mistake I see is people go looking for this Clorox house that's squeaky clean, perfect, nothing wrong with it, and it takes them months to kind of figure out like, all right, this is not what we're.
There's no perfect house.
I looked for 18 months. I swore I was not going to do renovations, and I ended up buying a house that did $200,000 in renovations with. So be realistic with expectations.
And it's better. You find typically better deals. Everything except
Correct.
structural.
Correct.
Right.
Correct. Absolutely. Surrounding yourself with a great team, a great realtor, a great attorney, a great home inspector, a great mortgage banker is very key. A lot of people just look online and they see the Bank of Omaha, and they're dealing with some guy who graduated high school 3 days ago and never did a loan in his life, and just because they have $500 cheaper fee or rate, they go with them. And there's more to it. than just the rates and fees. Plus, they change every single day, 2-3 times a day. So it's almost impossible to, say on this day I'm going to get the very best rate. I kind of explain this to the clients as if they were going in for a major surgery. Don't pick your doctor based on what he's charging you. You're going in hoping and praying that you're going to wake up. It's kind of the same thing. This is one of the most important financial transactions of people's lives.
Yeah.
Don't pick your team based on their rates and fees.
I was going to ask you, typically the interest rate you're going to pay is, based on the economics at the time and your credit, right?
Correct.
So out of the, hundreds of mortgage brokers that might be in their area, what are tips that you can give for them to find the right fit?
Well,
what's the difference with working with you?
So, honestly, I would say experience. If you're not working with someone that has experience, there's a lot of speed bumps that you can hit along the way that the person you're working with does not know how to handle.
Yeah.
Availability. I mean, I know it goes back to just business 101, but I can't tell you how many times my clients are so thankful. Like, Pete, I'm so thankful you always respond. You always answer the phone. And I'm like, wow. Is that really
pathetic?
Customer experience is huge.
Like,
customer experience in any business.
It's
pathetic
it's
how many
sad.
people don't answer the phone.
Yeah, it's hard.
It's sad. Even if I'm not available, or I'm in a meeting, or I'm in a closing. Hey, I got your text. I'll call you back in 20 minutes. Or hey, I got your message. I'm in a meeting or a closing. I'll call you back on my way home in an hour. They really appreciate
guys
that.
Like all three of us have to be on
100%.
The one thing
100%.
I changed, which I hesitated for a long time, but I changed my voicemail to say at the end, for a quicker response, text me.
Absolutely.
And it really does make the difference.
Yeah.
Because picking up the phone and voicemails get hard. But
when you're with
text
other
is
people,
always...
it's difficult. But like right now, I mean, we wouldn't pick up our phones now. But when you're in a meeting, at least you can pick up their phone for 2 seconds to text the person back without being unprofessional or impolite.
Absolutely. And I think people kind of get to learn how you are. So if you're with someone for 3 months and you just happen to not be available for that hour, they don't normally have a problem with that. So I think being responsive is probably the number one thing, because I will guarantee you will definitely hit speed bumps. There will be issues. There will be things that you never seen before. I have had a client where the seller died a week before closing.
Wow.
So it's not our fault, but we have to kind of navigate through the waters and see what happens.
We spoke about pre-approval,
Yep.
keeping the credit solid, the income solid. What happens in the case where there's some type of gifting? Let's just say, the parents want to give them money to help them out. How do you even begin to structure that?
That's a great question. And it's very, very common right now, considering where we are in the marketplace. Not a lot of, 20, 30-year-olds.
Homes are 700,000.
Yeah, exactly. So that is a very great question. So 2 things. If the parents know long in advance that their children are going to buy a house and they get them the money long in advance, then typically it becomes like a non-issue almost, because it's seasoned in their bank account for 6 months, 8 months, whatever the case may be. But a lot of parents kind of take a road that, well, we'll gift you the money when you find a house, and that's fine too.
Right.
There's a certain specific set of rules for that. As long as it's traceable and as long as they listen to their lender on those rules, then they should be fine. Throwing cash in the bank as a gift is a little bit of a challenge. About 2 months ago, I had a client where his dad was a business owner, and his dad wrote the check out of the business account to gift the son. And even though we got through it and we documented it properly, it adds a little bit of layer of
it could
complication.
count as income almost for them.
Right. We needed a letter from the CPA saying that it's not like a loan to the owner, or he's not taking it in advance on his pay.
Right.
And then that the business is stable enough. It gets complicated. So I definitely try to advise my clients to get a gift from parents or family from their personal accounts, if possible. And obviously no cash. And the less the better. I had a client where she got like, I think 6 gifts, 3 from one side and 3 from the other side. It was fun.
Yeah.
Trying to paper trail all that, but she said it is what it is. I can't get one gift from just one family member.
So you've been through several cycles now, right?
Yep.
Where do you think we are now?
We're in a very strange situation right now. Back in 06, 7, 8, and 9, we had plenty of houses for sale. It was foreclosures were going on, but buyers were very hard to qualify, and that was the challenge. Now we have tons of clients looking to buy and very little inventory.
And interest rates through the roof. I'm not super concerned about rates, because I do feel like they will come down again.
and that would be an opportunity for people to refinance. But
Do you
as
think
far,
they ever go back? Like, I think rates will maybe go to mid 4s. I don't think they ever go to 2s again.
between 4 and 5, I think is a healthy spot.
Maybe not even 3s ever again.
Unless another pandemic or something of that magnitude happens, I don't think we're going to see 3s. Definitely not 2s. But one thing about this world, you never know.
Yeah.
You never know what's right around the corner.
Do you directly correlate high interest rates with? I think we know the answer, but to value coming down, and then when the interest rates come down, the value goes back up? Because we don't see this in this market.
Prior to this, what's going on right now, that was like a guarantee seesaw. Like, that was an easy seesaw to predict. Rates are up, house prices have to go down. There are just so many people buying
and low inventory,
and so little people selling. I guess people are also very having a hard time selling their 2.5% interest rate to go buy in Florida or South Carolina at 7.
Yeah.
So I think once the rates do start to come down into the 5s, I think those people will probably get pushed off the fence, and wives and husbands or significant others would say, all right, I think it's time.
Right.
They've come down enough. But this is a very strange situation. Maybe the government comes out and incentivizes sellers to sell. Maybe they incentivize builders to build more. But we definitely 100% have an inventory issue that I don't know how quickly this is going to get solved.
Totally. How hard is it now as self-employed, right? Because we've talked about this thing. Pete put me into a loan years ago when I bought my own house. I got a really good deal at the time, but I needed a massive renovation. I bought my house for $550. I thought that I could do it for $200,000. Everybody told me there's no way you could do it, and I'm like, fuck them, I could do it. Sure enough, they were 100% right. Double your budget, add 20%. That's usually right. But luckily, you were able to get me into a deal with 5% down, very minimal PMI, and that's as a business owner. But we prepared for quite some time. Does that exist anymore, or is business owners very hard to?
You hit the nail right on the head. It's all about preparation.
Right.
If you're in touch with your mortgage specialist long in advance and he knows what he's doing or she knows what she's doing, you will know and understand the logistics of how a bank calculates self-employed income. We do not go off the top line. So if you own a deli and you make $3 million a year on the top line, we don't use that income. We use the bottom line income, which is after all your deductions. So knowing that going in is good. Some businesses are a little bit easier to navigate than others. Some businesses write everything off down to zero, and for self-employed owners like that, it's very much a challenge. There are some programs out there that are just bank statement driven, but again, I'm starting to see those banks dry up and kind of close the doors now with what's going on. So they have to be very careful. But I would definitely say preparation. You and I had prepped for a very long time prior to going into this. I mean, how many dozens and dozens of conversations leading into this, because you did the right thing, and we structured it properly, and we were both prepared for it.
Refied at the right time.
Yep, absolutely.
These days, there's a lot of different loan options and programs out there, right? A lot of people know the traditional 30-year mortgage, right? There's obviously a 15-year mortgage. There's a interest-only mortgage. I have a very unique perspective on this topic. I'm curious to know, what makes you choose a direction for your client to go to, and why you say sometimes a 15-year mortgage might be better for one person, maybe not another.
Sure.
And then I do have a very unique opinion or perspective on a certain program that exists, but I'd like to hear your opinion first.
So in my personal opinion, I would take a 1,000-year mortgage if I could, because I just feel like there's so many other things that you can do with that money. I got to a point a few years ago where I actually could have paid my mortgage off, and then I thought to myself, I have a 2.5% mortgage. Why am I paying my mortgage off? It's not really going to change my bills a lot.
Right.
I still have to pay my taxes, still have my car,
your insurance,
still have credit cards, insurance. So I decided at the time that I think my money is better off investing in real estate instead of paying it off, because if I paid it off, it really wasn't going to change my life.
I agree.
And one of my biggest regrets being in the business for 23 years, it's like the shoemaker with the dirty shoes, is took me way too long to start investing in real estate. Had I started to buy houses 10 years, 15 years ago, I probably would have had 10, 15 properties at this point, and our retirement probably wouldn't be so far away if I voluntarily wanted to. So that's probably one of my biggest regrets. So back to your question about the loan programs, it really just depends on everyone's specific scenario. It depends on how long they're going to be staying in the home, Right now, a lot of my clients are taking interest-only mortgages. They're taking 7-year ARMs, which means adjustable rate mortgages, 10-year ARMs. Why? Because in the next 1 to 3 years, I think the overwhelming opinion is that we'll be refinancing.
Right.
So it really depends on the person's scenario, depends on their age, depends on how long they're keeping the house. It also depends on if they have a house that they're selling. A lot of people are buying their house prior to selling their old house. And then we either refinance the new one, or we could do what's called a principal pay down, and then we could just readjust their current mortgage. So really, a lot of people's scenarios are very unique to them. So we really try to dig deep and uncover, what's going to make sense for that person. I make a recommendation, and then, they choose whatever they want.
A traditional mortgage, for most people, for some people that might not understand, is you're paying back principal and interest each month. And early on, you're paying very little principal.
Correct.
And over the course of, let's just say, a 30-year note, towards the back end, you're paying much more principal and less interest.
Absolutely.
My approach, which I think you must be a sophisticated investor, you must have experience, you must exhibit discipline and consistency, is I'm a big fan of the 10-year interest-only mortgage. And I'll tell you why. If you're get a 30-year mortgage or even a 15-year mortgage, every month you're making that payment, and let's just say it's a $2,000 payment, and for argument's sake, it's $1,000 for interest and $1,000 principal. That $1,000 of principal is going back into the bank's pocket.
Correct.
You don't have access to it.
Correct.
It's not earning interest for you. It's literally just money being parked away. If you have faith that in 10 years your property's gonna be worth more than what it is now, which in most cases it will. Again, you could get caught up in a bad market.
Right.
And you have the discipline that $1,000 that would have went to that principal, you put and invest someplace else.
I agree.
That's how you can build a bigger real estate portfolio. That's how you can keep your monthly expenses lower. But again, don't take that money and buy a car or go to Disneyland. Earmark it. It's out the door as an expense, but put it someplace where you can earn more.
Absolutely.
More bang for your buck than parking it back in the bank's pocket.
I agree.
And go ahead. We've had this conversation before.
Yeah, and I was always against 5 and 7 year ARMs, but like I got friends that are in Hoboken in the city, and like they've done very well with that, really well. And when you think about it, when you're only going to be somewhere for 5 or 7 years,
It's almost,
it
makes
so much sense. And I don't
fixed
know
for the
why
whole
I just
period
was
of time.
never. I guess I was traditional in the mindset of like 30 or 15, but like it's a great tool.
I'll tell you why. Everyone thinks life's permanent, right? Like even if it's a starter home, they want the security that I'm good, right? And the truth is, nothing's permanent.
Correct.
I mean, life changes and evolves every single day.
5 to 7 years.
Yeah, I've
average.
and I'm not, I don't know if I'm proud about this, but I've literally moved my family every 5 years.
Yeah.
It's an insane. I look back, and it wasn't a plan. It just I saw opportunities and
Absolutely.
and there were market changes, and I just did it. But if you asked me when I bought my first home when I was 25 years old, am I going to move every 5 years? I'm 43 now.
Never in a million years.
Never in a million years. I said, maybe I'll move. I'll have a starter home and then maybe buy my dream home. And it's you can't really think of it as more of a permanent solution. It's just what works for you today.
Absolutely.
And I think that's probably going to be the biggest theme of this podcast in general is, and anybody real estate business owner, basically things are just constantly fluid. They have to change. And I just think that when it comes to moving, you just don't know, right? And there's, from an investment standpoint, I have a client that, and a client, he's a friend you know very well too. He's got he's got an investment strategy of 15-year mortgages. That's his model. And the way he did it is because he has a time that he plans on retiring, and he's like, that's my income. And I happen to really love that model. So I bought some 2 families last year that I did 15-year fixed mortgages on. Now people do different things for college and whatever. For me, I'm putting one of them in my kid's name, whether it's in a trust, whatever it is.
It's a great
15-year fix now. So now their college is essentially paid for. And I'll give them the decision of what they want to do at that time. But in that case, that's a great strategy.
Absolutely.
I would prefer to do a 15-year fix. Maybe I'm gonna sacrifice the income in the meantime, but for that, for my investment goal at this time, I happen to like that a lot.
But over 15 years, the interest rates listen, that's 6 months ago or 7 months ago, they were at 3%.
Right.
And now they're 8%. And those big interest rate swings, you don't know. You lost your job.
Right.
You got married. You had a baby. Things happen. Interest rates drop to 2-3%. You have to be able to ebb and flow and make a move.
Absolutely.
And there's an expense to refinancing as well. So you have to really assess it. The 10-year interest only, I think, as long as you have faith in real estate going up in the 10 years, you know, and you're disciplined enough to take that money and really invest it
I
someplace
think the
else and not
second
go on
part's the
vacation.
biggest thing is
Yeah.
you truly got to be disciplined.
Correct. 100%.
So I'm making a prediction now with I guess I don't want to call it this generation, but the people that were prepared to buy now.
Mhm.
Okay, and I have a guy that actually works for me. He did all the right things, right?
Mhm.
He works hard. He makes a good living. His wife works hard, makes a good living. They save their money, and this year they were ready to buy their dream home. Let's just call it the $1 million Center Hall Colonial.
Okay.
And now they can't because the
Mhm.
interest rate went up so high,
Right.
and they can't afford the monthly payment, although they have the down payment.
Right.
But for 2 or 3 years, they've been manifesting, this is where I'm going, and they've been making sacrifices. They've been living in a
Mhm.
one-bedroom apartment, right? So
Mhm.
in their mind, they're already there.
Right.
So now they feel like they're being punished because the interest rate went up, and now they
Right.
can't have it. So they don't want to pivot and buy the semi
Right.
or the townhouse
Right.
because their head is already in that Center Hall Colonial.
Correct.
So what are people doing? They're renting that Center Hall Colonial instead of buying it.
Right.
I
And
know
then-
2 people that did that recently.
Now, what happens if you don't have the discipline? Well, that down payment you had, you know what? I'm
Gone.
renting now. I'm gonna fully furnish the home.
Right.
I'm gonna buy the car. I'm gonna go on the vacation. And now they become permanent renters as opposed to having that nest
Right.
egg.
They were almost there.
To now they had their nest egg. They don't have it anymore. The interest rates are gonna come down. Things are gonna come back to normal before you know it. And guess what? Like, damn, we can't buy this house that we're living
Yeah,
in.
that's a shame.
You're creating a whole, I don't want to call it a generation, but this 1 year gap,
Yeah.
all these people that were going to buy and decide to rent will now, chances are,
Mm-hmm.
rent for their entire life.
You're
Which
right.
is why you see people like Bill Gates and Elon Musk buying hundreds of thousands of one-family homes across the country because they're recognizing there's going to be a rental market for these people where before that rental market may not have been as strong.
There's going to be
That's
a
a great
lot of
point.
people accepting the fact that they're going to be renters for life.
Yeah.
And maybe that's not a bad thing. I mean,
Yeah.
I firmly believe that your primary residence is a liability. With that said, I own my primary residence, right? And I like that I do. So, because the part that sucks about that is would you hit it, right? You buy a Center Hall Colonial. Not very many people are buying a Center Hall Colonial to rent as an investment.
Right.
So chances are, and I've seen that before, you do furnish that home and then you get
Mhm.
kicked out.
Yeah. Yep.
And even if you decide to sit there and squat, you got a year or two where you're going to be out. So
Yeah.
I mean, it's just, again, it's all personal.
Yeah. Yeah.
Absolutely.
I mean, listen, I've owned, since I've been an adult, I've always owned my primary home. I'm renting now. And there's some, I gotta tell you this, I'm really liking some of the aspects of renting the home, right? Something breaks with the stove, I'm not
Yeah.
fixing it. The doorbell stops working, I'm not fixing it. And then you're taking that money, right? Going back to that $1 million home.
Yeah.
You need $250,000 to buy that home.
Right.
Well, rent that home, take that $250,000, put it to work for you, it pays your rent.
And there's just so much shit with a house. Everybody always said it that
Yeah.
like, oh, it's always
It's-
something.
it's a
And I
lot.
got to say, I literally basically built a new house and there's constantly shit.
Yeah.
It just,
Yeah.
and it's just, I was in
I
a
agree.
building and I had an app. I didn't even have to call. I had an app that I filled out a maintenance thing and that day
Yeah.
it was fixed.
Yeah.
And I didn't have to pay
Yeah.
for it. And it was great. So, it's all individual to.
There's definitely a value to that for sure.
We've been ingrained in our minds. I think it started in the 50s or 60s that the American dream is,
Mhm.
and maybe this goes against the residential mortgage world, but the American dream was home ownership,
Yeah.
but
Yeah.
it was really the banks
Right.
selling this dream so the banks could earn more money on the interest, right?
Yeah.
But listen, it's really the lifestyle you want to live. You could be a homeowner and you're gonna do well. You can rent and do well, but it comes down to being disciplined with your money
Disciplined,
and
yeah.
consistent
Absolutely.
every day, and get up and work hard. And as long as you get up every day, work hard, and you're disciplined, you're gonna be okay.
So you want to hear something interesting? So my son was born last week.
I
Right.
know. Congratulations
Thank
again.
you very much. So
It's
I
amazing.
wrote down all like significant things that I could find about the date, about the time of year, this and that. So I didn't even know what generation he was. And do you know what it is?
I have no idea.
Do you?
No.
It's Generation Alpha.
Oh my
I
god.
didn't even know that was a thing. So he's Generation Alpha.
All right. He's gonna be an alpha man.
I wonder. I know. I love it, but I wonder what that's going to look like, right? Because you
Yeah.
got next. So what? I'm a millennial, and you got Gen Z.
Gen Z.
Yeah.
And is he
So that
right
might
after
be
that?
why it's alpha, right? Z, and then they went back to being the alphabet to A.
Yeah.
Could be.
Could be. Yeah.
That's crazy.
Interesting.
So you've been doing this a hell of a long time. Crazy
Yes.
stories.
Yes.
Crazy stories. Funny stories. Horrible stories.
Well,
Unique stories.
The most horrible one had to do with myself when the banks closed on my own mortgage that we were trying to close on. And my
you got to back up and start that one from the beginning. I know before that we started, went on air, you started telling us that story. So what year is it?
This is 2007.
Okay.
Getting married, buying a house, getting my own mortgage, doing my aunt's mortgage. Things were great. And then banks were literally closing 20 by the day. There was even a website, mortgageimplode.com, and like every 20 banks that was closing. And I got an email at the place I was working, that the lender that we had placed my loan and my aunt's loan with, like, closed. I just couldn't fathom that. I said, what do you mean closed? Like, for the day or for the week?
Right.
Or permanently?
They closed for lunch?
Yeah, like, what do you mean closed? Banks don't close, So we had to pivot.
And that's happening again?
The whole store had the flu.
A little bit. Yeah, the whole store had the flu. A little bit, but thank God not anywhere near as it was in 2007. So obviously I had to pivot, just like anything else in life. I had to replace my loan, my aunt's loan. We both took higher interest rates, and thankfully we refinanced since then.
Right.
But again, going back to my point is I bought at the worst time in American history, in my opinion.
Right.
And I made out great. I ended up selling the house for what I bought it for, had $100,000 in equity to walk away with, and had a house to live for 7 years, got married, raised 2 children there, and then eventually bought another primary residence.
The banks closing back then compared to now, we're hearing the news banks are closing now. Probably for similar reasons, but obviously some different things in the economy. If you can explain in layman's terms why they were closing then compared to now, and I know there are probably some similarities, how would you describe it to somebody?
Well, then there was a tremendous amount of no income documentation loans where people were going to buy 3 investment properties with no money down, and they were stating they make X when they really didn't. So it was a really reckless time in lending, which I didn't agree with, but that's...
And you saw it all the time.
Well, yeah, I would give my advice to someone and say, hey, Rob, I just don't think that, you and your wife are going to be able to manage this rental property. You're not putting any money down. You don't have any savings, et cetera, et cetera. I don't really, in the nicest way possible and most respectful way, I would say sometimes I don't think this is a great idea. And some of them would just move forward with it.
Yeah.
So
a lot of banks were overpromising, saying,
correct.
Hey, at least you can afford this.
100%.
You can afford this. Do it. And
yeah, well, those rules just should have never been there to begin with. Now the difference is the people who are getting loans are qualifying.
It's the banks being irresponsible with the money.
Correct. I don't think that banks were really prepared for this gigantic swing in rates and yield and everything. So I don't think that whatever goes on in their back office, I think this kind of threw a monkey wrench into their investments.
And you had the crypto stuff. I mean, there was a lot, that changed in the world.
Right.
I mean, there was a lot of changes.
Also, I think a part of the banks that closed recently was the jumbo mortgage lenders who were giving out loans for almost nothing, 1.5% to 2.5%, and I don't think that they counted on everything changing so quickly, and then they were stuck with a lot of these portfolios worth billions of dollars that they couldn't do anything with. But luckily I don't think it's affecting anywhere near as many banks as it is that it was in 2007.
It goes to show that there's a fine line, because and I don't know how strongly you feel about this one way or the other, but I don't agree with the debt to income model that you guys that banks so strictly follow. Because how many mortgages do you technically have? I mean, you definitely exceed the debt to income so many properties ago. Yeah, and I just feel like there should be a different rating system. Like, if I've never missed a bill in my whole life, you should give me a mortgage, right? But yet I technically don't make enough, or whatever it is. But and the funny part is that as a real estate guy, I can't tell you how many guys don't have this. I mean, $50 million net worth, $100,000 a year. $30 million net worth in real estate thing. Me and my wife make $140,000 a year.
Right.
I mean, it's just that's how business owners are structured.
Right.
And
so it's like, but then there's, of course, the other side where they went way too off the deep end, where you work at McDonald's and you're buying $1 million house.
Right. They should definitely loosen up some certain areas in lending. I in my opinion, like to your point, if you have $50 million in the bank and you don't have the income right now to qualify, if I'm going to lend $200,000 to that person, I'm pretty sure he's going to pay it back.
Right. Proving you've been financially responsible, I think, is huge, right?
Correct.
I mean, you have a track record. Over the course of 15 years, you've never been late, never been foreclosed on. You can manage money responsibly, I think, is huge too. I think And I think in the commercial world that probably lends itself a little bit more, not on the
Right.
on the residential side.
Right.
Where it's asset driven. Yeah.
Yeah.
Correct.
I think going back to those adjustable rate mortgages, times like this where you have a 5-year ARM, 7-year ARM, 3-year ARMs wrapping up, where they used to be paying a 2, 3, 4, 5% rate,
Right.
and
A lot of
now
people
are
in trouble.
they're forced to jump up to the 8% rate.
Correct.
They clearly can't afford it.
That's
they're
gonna
going to
be
go
a
into
problem.
foreclosure.
That's
You're
going to
going
be
to
a
see the
problem.
inventory, drop out. That is going to be the next big.
Yeah.
And on the commercial side, forget even affording it. Now you can't qualify for it. So now you got it's not even like you're just going to have no money left. It's you can't even get it.
Yeah.
Right.
So now you're really in trouble.
Yeah.
So
How are you preparing your clients? I'm sure you've issued some 5-year ARMs, 7-year ARMs, 3-year ARMs that are actually expiring now. Are they coming back to you now saying, "Hey, what do I do?"
I did not actually recommend a lot of them when rates were so low. I actually made that mistake myself. I had the opportunity to get, I think it was 3 1/4 on my primary residence when I bought it in 2014, and I ended up going with 3 on a 10-year ARM. So I saved a 1/4 point. I thought I did the right thing, and a couple of years into it, when rates started going up, I'm like, oh, did I do the right thing? I mean, I kind of regretted doing that. And then luckily I had an opportunity, during COVID when rates were ridiculously low. I got 2.5% with no points, and it was a 30-year fix. And I said, all right, now I'm comfortable.
Lock in.
I don't really think that I did a lot of ARMs at that time because it really wasn't there really couldn't be a big difference because there was really nowhere else to go.
Right.
If a 30-year fix was 2.75, what was an ARM going to be? 2.5?
that's a good
For the
point.
1/4 point, it's just
time.
not worth the risk. Now, totally different story.
Yeah.
If you're at 7% on a 30-year fix, or you can get, let's say, 6 1/4 on a 10-year ARM on a $900,000 loan, that's a big deal. That's a $600, $700 a month savings. So
During COVID, when you were doing all these refis, and because the rate was so cheap, were you also recommending a cash out at the same moment to pull that equity out at such a cheap rate?
I kind of recommend things based on their needs. I wasn't like recommending to everybody to go do it, but when somebody came to me and said, hey, I got jammed up, I got $50,000 in credit card debt, I said, well, here's a solution
Here's
for
your
you.
opportunity.
Hey, I would like to build and renovate. A lot of people were home. Not many of us were not really doing much.
Yeah.
So everybody was thinking about, how can I expand my house? I want to fix the bathroom. I want to do the basement.
Put that pool in.
Put the pool in. There you go. So the best way to do it at the time was to cash out refinance. So yeah, we did a lot of them.
Yeah.
Or put it
We
on your
did a
credit
lot of
card.
them.
Smartest people in the
Just
world.
doesn't count.
Smartest people in the world, man. Are those during COVID, getting into those 2-3% rates for 30
Yeah.
years.
Yeah.
Unbelievable.
Who knew though?
So, what do you think? What are you seeing as far as, one thing that I love is that culturally now, like in-person closings are really rare. And I still tell my clients that I'm not allowed to go to the closing because of safety. Because I hated that. It's such a waste of a day. I mean, listen, if you have that slow of business where you can take half your day, and you got a problem. You need to be building your pipeline, not going to a closing. So, are you seeing in-person closings, back 100%?
Within reason and within my own time blocking ability, I do try to get there, especially if it's within a half hour to a 40-minute drive. A perfect example is 2 weeks ago, went to a closing in Brick, met the seller's agent at the closing table. I think she was representing both. And at the time, I ironically had a client that was referred to me by my cousin that worked with him, and he happened to be looking in the area she specialized in. So, I thought it might be a good fit. I made a recommendation with her and a few other realtors to maybe have conversations with them and see who you like best, and they ended up hitting it off, and she found them a house. I think they're going into attorney review today.
Yeah.
So I am a believer in going within reason. I'm not going to drive 3 hours into South, Jersey or Delaware to go to a closing. But a lot of times, if the closings are in the same day or generally in the same neighborhood, I try to attend. I do think that they appreciate that.
Oh yeah, sure.
It loosens things up a little bit. Crack a few jokes. I say I'm here with the money, with the suitcase now.
I also think his role and your role may be a little bit different at the
It
closing.
is different.
Yeah.
It is. It is.
Your
Totally.
job is pretty much
Totally.
done and being
You're
executed.
seeing them the whole time.
True.
I
God, that's
may
a good
not
point.
have
I
saw.
didn't
I
think of
may
that.
had not have even met them from day one.
That's a good point.
So on my side of the fence, that could be the very first and last time I see them.
Plus, you have a good opportunity to meet like the other realtor on the other
Correct,
side.
correct.
You know, you've actually had an interesting
Correct.
way of building business. Me and Pete actually met because I was selling a house to I forgot his last name, Anthony. He bought a house, and I forgot what the terms of the deal were, but it was something where there was like no contingency and there was a crazy tight time frame.
Mhm.
And this guy comes out of nowhere and he's like, I can get this deal done in 30 days. I'm like, now this is like where that just didn't happen.
Right.
And he got it done in 30 days. And then I was
Yeah.
like, wow, this guy's been like super transparent. I get him on
Yeah.
the phone. And then that's how we started working together. And
Yeah.
honestly, to your credit, and I think probably and I just recommended a family member to him, you're always super transparent. You're always the first person to tell you, listen, I can't do this.
Likewise,
Somebody's telling you they can.
Yep.
They can't. I don't know how. I think you respect people's privacy. You respect
Absolutely.
their documents, all that kind of stuff.
Yep.
And I think what you hit it on the head with experience, and it's just everything should go a certain
Mhm.
way, right?
Mhm.
School says it should be this. You
Right.
know, a transaction should go like this, but they just don't.
Right.
Right, the world is changing
There's
too
always
much.
something.
The banks, there's just way too much, and that's where the experience comes in. You want somebody that,
Mhm.
when something does go bad, they don't cave. They
Yeah.
they attack it. you know?
Absolutely, 100%. Yeah, and I think that's why we hit it off. You know, when we met.
Absolutely.
We very similar work ethic, and you know, it's been great since then.
Absolutely.
What's your before we wrap up? Tell me your prediction the next year. Interest rates, business, sales.
I would like to say that I think rates are going to start going down Q4 or this year or Q1 next year.
Because of the election?
I don't know, just because I think it just has to.
Yeah.
You know, I don't think it could stay this high for that long. As far as inventory is concerned, I think this is going to be a continued problem for quite a few years, unless a lot of people get pushed off the fence to finally sell because rates have come down, or unless, to your point before, a lot of people who may have taken ARMs and now they're resetting 5% higher can no longer afford the house, and unfortunately,
They're gonna have to
the
sell it.
result would be foreclosure or
Or
sell.
massive layoffs. That's
Yeah.
the only thing that I think could be the driver for
Yeah,
people with a 2%
it's going to be an
mortgage to
interesting,
sell.
interesting
Right, just
12
can't
months for
afford
sure.
it.
Yeah.
Definitely an interesting 12 months.
Do you think these banks that locked in these notes at 2-3% would let them transfer over if the people are going to lose the home, or are they just going to let it fall and grab the higher interest rate?
So you're talking about like assumable?
Yeah.
That's a good question. As far as I know right now,
I think they're going to grab the additional interest.
Some FHA and some VA loans are assumable, which would be a great question for a listing agent to ask a seller while you're on that appointment. Hey, by the way, what kind of a mortgage do you have?
Every single one
If
I've
they
tried
say-
to, hard no.
Yeah, I would say 99% of them probably are no, but you
I'm
never
even
know.
seeing commercial banks calling notes, going through, looking for things,
Yeah.
looking for things that don't line up. Because when you sign
Yeah.
those 50-page documents, you don't know
Yeah,
what's in
you don't
there,
know what's in
Yeah.
and
there.
you're never complying somewhere.
Yeah.
That's right.
And if they want to call it, they're gonna call it.
Yeah,
It's going to be
Yeah.
an interesting couple of months.
definitely will. But
You hate to see people lose their homes, but
absolutely,
hopefully everything shakes out the way it's supposed to.
yeah.
Pete, thank you so much for coming.
My pleasure.
This was
Thank
great.
you for having me.
I actually learned a bunch from this one.
Great,
Yeah, this was awesome.
great.
Pleasure
My
as
pleasure.
always, man. Thank you.
Thank you, guys.
And I got you into Cuban cigars finally.
Yes.
Over our friendship.
Yes, absolutely. Big fan.